parece bien, voy presentando un poco la mesa. Ya sabéis el tema de hoy. Tenemos la suerte de tener aquí tres invitados de excepción. Voy a empezar presentando del extremo de la mesa hacia aquí. Primero Jaume Puig, que realmente no necesita mucha presentación, director general de GVC Gaesco. Se unió a la compañía en 1995 y ha sido, pues eso, analista jefe, responsable de inversiones, director de inversiones y consejero delegado de GVC Gaesco Asset Management. Luego tenemos aquí a vuestra derecha a Scott Meech de VP. Es corresponsable de renta variable paneuropea. Scott es una persona muy conocida en la industria, un track record muy largo, con su experiencia previa en nivel y su periodo en VP también en responsabilidad de renta variable europea. Entró en VP en el año 2010 y, como os digo, pues es uno de los gestores de referencia dentro de la clase de activos. Y finalmente aquí a mi derecha está Rodney de Aberdeen Asset Management. Rodney está dentro es gestor del equipo de renta variable europea y de Reino Unido de Aberdeen y está trabajando con Aberdeen desde hace aproximadamente 10 años. Se incorporó exactamente en el año 2005. Pues eso, el tema, como sabéis, hoy vamos a hablar de renta variable europea, de las oportunidades y los retos que se presentan en la clase de activo. La presentación, más que presentación, va a ser un diálogo. Intentaremos que sea una conversación lo más fluida posible. Os invitaremos a participar desde el principio. Si queréis ir haciendo preguntas, podéis interrumpir y ir preguntando desde el comienzo. Hago esta pequeña introducción en castellano, pero la presentación será toda, la conversación será toda en inglés. De todas formas, podéis hacer preguntas en castellano, en catalán, lo que queráis, y los miembros de la mesa pues se la traducimos y la idea es que os sintáis cómodos y que podáis participar. Pues si os parece bien, comenzamos. After this brief introduction, I've been talking about you. It's been laudatory, I guess. We will kickstart the discussion. I would like to start maybe. I was telling the audience that the idea is to have like an open discussion. We can start the discussion here, but we are open to questions from the audience at any time. And I would like to start, if it's okay with you, with valuations. With valuations, and one very direct question, which is: have we missed it already? If we are not in European equities, is it already a good time, or are we relatively late? If you can give me your view on how you see valuations right now. I know that you have a relatively similar view, but at some points with some little bit more extreme opinions. We can start maybe with Jaume first.
Okay, thank you. Well, relating to valuations, the thing for us is quite simple because, for instance, if we do, I just put two examples. For first one, bottom up, and second up, top down. So, from a bottom up perspective, for instance, we value the Euro Stoxx 50. So we value each of the 50 stocks in the index, just from a DCF, special DCF, and then we just aggregate everything and reach a value. Okay. And the value that we have, fundamental value of the Euro Stoxx is 4,200. So we started the year at 3,100. Now we are more or less at 3,600. So we are still at the middle range. So for us, the thing is, from a valuation point of view, is simple. We have to be bought. If we look at top-down approach, then we do it in a different way. But this is more or less the thing. The thing is the following. If you look at the long run, there is, if you look at two data, one is the GDP, but current GDP, not constant GDP. If you look at current GDP on one side, and then if you look at the equity, an equity index without dividends, okay, more or less, if you manage to see that, both of them, at the long term, used to have a similar pattern, okay? Then if you look at these two variables, from comparing 2.7 with 14, so before the crisis and the last year, there is a significant difference. For instance, If we look at the GDP in the world, current GDP is plus 36%, and the equity world, if you look at the MSCI world, is plus 3%, all in dollars, just to be compared, okay? So generally speaking, we should see that the world, or the equities in the world, are behind, lagging the economy, not in front of the economy, you know? But it's very interesting because if you look this within regions, you might see a significant difference. For instance, in the US, current GDP growth is plus 20%, and equities are plus 40%. So in the US, all the return of the equity index is further, the economy. But if you look, for instance, in Europe, that's not the case in the Eurozone. In the Eurozone, current GDP growth is plus 6%, and equity index without dividends is less 40%. So if you do this kind of analysis, there are several regions in the world which are lagging, and the most important of the two being Eurozone and emerging markets, so from a top-down perspective. No? So from both sides, we think that, of course, there is a huge run in the equities in the Eurozone in this first couple of months, but we think that there's a lot to do yet. Okay? Thank you.
Great. Scott?
Yes, I would. It's interesting. We all look at these things slightly differently, and just to add some slightly different ways of looking at the same problem. Certainly. That's better. Sorry, apologies. So just to look at things slightly differently, a slightly different perspective. From a top-down perspective, we see US multiples of about 17.5 to 18 times earnings for calendar 2015. Eurozone being plus the wider Europe being about 16.5 times earnings on consensus numbers at the moment. So a little bit of a gap, but I think the point made about where we are in terms of the cycle is very, very important. We're completely dislocated from the US cycle, never more so than now. So if you look trough to peak, US earnings are now 20% above previous peak levels. So you're valuing those earnings at 17, 18 times earnings. European earnings are still 30% below peak. So we're looking at very different pieces of the cycle. And to put that in a slightly different way, return on equity in Europe for the European corporate sector is at an all-time low compared to the US. So we're at a very different point in the cycle. We have the European Central Bank in a very different place to where the Fed are. Fed trying to pull back from stimulus, and the ECB very much on your side. So the ECB is on your side as an investor in Europe, which I like. Another point I would add, I don't want to talk for too long, but there's a very big difference also in terms of leverage in the corporate sector in Europe compared to the US. So in the US, corporates have used low interest rates, have used cheap debt funding to lever up more. And that's typically what companies do when economies recover. They get more confident and they lever up their balance sheets. So in the US, that leverage has been used, and the average net debt to EBITDA for the US corporate sector is approaching 2 times now, which is a typical point to reach towards the top of a cycle. In Europe, we're still at the low point, so we're still seeing ex-financials net debt to EBITDA of around about 1 times. So we're still at a low point. European companies have not invested yet, have not used that balance sheet leverage. And so when you're looking at those PE multiples, that's really important, because as companies take on leverage, which they're beginning to do in Europe, they're taking on that leverage at incredibly cheap funding costs. You have corporate borrowing costs at an all-time low. Just to give an example, CRH, a UK building materials company, aggregates, cement company, so a very basic company, has just proposed a deal to buy a bunch of a set of assets from Lafarge and Holcim, who are merging, and the funding cost for those assets for 7-year funding is less than 2% for that company. So the earnings accretion from that deal could be upwards of 30%. So my point is that as companies in Europe use that potential leverage, the PEs can come down quite sharply when they do so. So looking at essentially we're looking at a higher quality of earnings because of that low leverage on the balance sheet. So I would add that to the conversation.
Perfect. Rodney?
Thank you. David, I mean, it's an absolutely fascinating question that you ask, and the key challenge for us, Aberdeen, is really valuations at this point in the cycle. And I hear what my colleagues on the panel are saying, and yes, a lot of this is true, but actually I would argue, and our view at Aberdeen is actually we're a little bit more cautious on equity valuations at this point. I mean, clearly we've had a very strong run for equities, up 20% in each of the past 3 years, and better than that over 5 years. So we've enjoyed a strong run, and that's been driven by quantitative easing, first from the US, the UK, Japan, and then more recently, obviously, in the ECB, and that has really supported equity valuations. We've seen a huge re-rating in equity multiples. So effectively, investors are paying more for much the same thing. I think there's a couple of things that we need to be mindful of when we look at average Ps for the market. As Scott says, 16 times for the European index at this point in time is okay on a historical basis, and it's actually pretty attractive relative to the US on 17, 18 times. But I think once you start looking into the index, looking into the components of the index, it gets interesting, because what you've seen is a very strong re-rating in the secure growth companies, businesses with robust business models, strong prospects for growth, international operations, so well positioned to deliver 3, 4, 5% sales growth and high single-digit earnings growth. But there's a huge divergence, and you've got the oil sector, you've got the commodity sector, you've got banks, you've got utilities. All of these sectors are facing unique challenges of their own that I would argue justifies a lower multiple, and their near-term prospects for growth are much weaker. Clearly, if you look at, I suppose, in aggregate GDP, and you look at, in aggregate, the stock market performance, what you miss from that is what's happened to banks, the banking sector, and the huge amount of equity recapitalizations that's taken place, and that obviously has to weigh on the performance of the index. And looking forward, the returns for banks are going to be a lot more challenged. It's much more difficult for investment banking activities with regulation. ROEs are going to be lower going forward because of regulation and increased capital requirements. There's still a huge amount of uncertainty over the risk-weighted assets regulation and what's going to happen from Europe over the next few months to the end of the year. And the prospective returns for these businesses are going to be much lower going forward. We're hearing reports of 10 to 12% ROE, which would be something of an achievement in the context of where we are today. You look at the oil sector, we've all seen the huge derating in the oil price. It's halved from $120 to $60, and that's going to have a huge amount of impact on the near-term earnings for these businesses. And near-term, they're going to continue paying their dividends, but they're cutting capex, which means future production will shrink, and you look at the banking sector, the oil sector, the commodity sector, mining. Again, near term, a lot of pressure on China navigating a soft landing, and the utility sector as well, where returns are depressed. So a huge amount of discrepancy, I think, between the sectors. And when you look at the businesses that we like to invest in Aberdeen, which are strong business models, competitive advantages, strong prospects for long-term growth, intellectual property, good customer relationships, pricing power, all these kinds of businesses have actually re-rated quite sharply and trading on 18, 19, 20 and plus times earnings. And these are high relative to history. On an absolute basis, they're high. I mean, the only real argument that you can make actually as to why they're cheap is actually relative to bonds. Mm-hmm. And so I can sort of see the argument that yes, there is more to go for in terms of a re-rating for the European market, especially relative to the US. But what makes us nervous really is the unprecedented degree of ultra-loose monetary policy that we have at the moment supporting equity markets. Mm-hmm. And really the question in 6 months' time, or maybe even sooner than that, is what happens when the Fed raises interest rates? Because US investors are big investors in Europe, globally. And historically we've seen, over the past, I think, 40 years and the 5 cycles that we've seen where the US have tightened, that's had an impact on equity markets. And that leads us to be cautious. I don't think you would say that equities are expensive or in bubble territory, but I would say valuations are pretty full, and you really have to hunt pretty hard to find value. I think you have to be selective. You maybe have to go up the risk curve now. I think Scott talked about the businesses in cement, which is a more cyclical business. You look at, I suppose, the mining sector. You need to take a long-term view and look through the near-term weakness in China and the reduction in infrastructure investment. You maybe need to look at some special situations, banks where you feel that these these businesses can deliver attractive returns over the long term and can grow at superior levels. And maybe Standard Chartered is a good example of a company that's been hugely beaten down access to global growth drivers and faster growth emerging markets. Tesco is one that we looked at in the UK, which is a bit of a special sit. It's been through a very challenging operational period. But again, that there could be value there. And there's a number of other interesting areas, businesses which are on depressed multiples with scope to grow as global GDP continues to improve. But I think it's a lot less compelling, and actually at this point in time, it's a lot harder. It's a much harder decision to shift and allocate into equities than it has been, I would say, for the past 4 or 5 years, actually. So that's our view. We're a little bit more cautious.
Great, thanks, Rodney. It's true, picking up at the last part of your argument, it's true that we have to take into account the Draghi and the monetary policy into the equation. Scott, you also Rodney, did you mention the discrepancies in the cycle and discrepancies in monetary policy? What type of effect would you expect? I mean, we're seeing the start of the European QE, and we might see the reversal of the impact of the accommodative policy in the US and maybe at some point also in the UK. What sort of net effect are you expecting for the market? And in terms of flows, what do you think that we could expect from monetary policy?
Sure, I think, Rodney makes a very good point about where the US is in the cycle and this impact that we've had about, very, very low yields forcing the valuation of these high quality stocks up. And actually, if you look at, there is a sort of crossover. If you look at the beta characteristics, the risk reward characteristics of those very high quality stocks, and you compare them to high yield credit, they're actually not very different. So you can see there's a direct impact there of what's happened in the rates world. And because of this dislocation in the cycle, it is quite difficult to see the US go through a rate tightening phase and all of the volatility and problems that might bring for the US market without the European market being impacted from time to time. So I think it's right to highlight that, and there will be opportunities. So we need to watch that very carefully. In terms of QE in Europe, I think the primary effect has been to reduce the level of the euro. The ECB highlighted competitiveness of the euro nearly a year ago, and it being a primary sort of target almost to get the euro down. And they've done an incredibly successful job of that. And I think that we're only just beginning to see the benefits of that element of QE. So a lot of the QE benefit we've had in advance. Moving forward, I think there's a crucial element to how QE is actually executed in Europe, which, to Rodney's point about where the value is in the market, and it's some of the perhaps more broken, deeper value, more cyclical areas of Europe where there is more clear value opportunity. One of the biggest chunks of that is obviously the banks, and how will QE potentially affect the banks in Europe? And a lot of comments have been made about how just by buying sovereign debt, it's very difficult to see the ECB reaching its QE targets. There simply isn't the stock of sovereign debt in Europe that there was in the US. It's not as easy. So it's hard. That raises lots of questions. Not least, do rates rise in that environment? QE in the US has prompted yields to rise for 6 months, and that doesn't seem to be happening in Europe yet. Maybe because of this sort of lack of supply. So QE has got to change and adapt to our mind. They've got to do something else over the next 2 years to make it more effective. And it's very interesting that the ECB have been working on green papers and have been having discussions about what other assets they might be able to buy. And one of the key elements of that is whether they can buy bundles of securitized debt from the banking sector. So quantitative securitization, or whatever you want to call it. And it's a very early stage of discussion, but if they can find a way to lift assets from banks' balance sheets, allowing banks to securitize bundles of reasonable quality debt, then potentially you could take the wholesale funding cost for the banking sector down quite materially. and the banking sector in Europe, going back to these differences in PE multiples, is trading on about 10 times earnings for this year. It's one of the highest yielding sectors in the market, surprisingly now, close to a 5% yield. So if there's a way in which the ECB, via the QE process, can support the banking sector, increase margins, force them to lend more, then I think that's one of the potential big positives.
Jaume?
Yeah, well, we have to take into account what Draghi said at the beginning of May last year, okay? So, which is the purpose, final purpose of the quantitative easing, no? The QE? I don't think is at all the real interest rates. I think that the real purpose is currency, as you mentioned. So it was very strange. Eurozone was quite weak in GDP, importing deflation, low GDP growth, and we had a very expensive euro. For instance, euro was by that time at 140, and if you look at the fundamental value of the euro against dollar, it appeared to us 117. So so the real purpose of Draghi was just lower the euro. So I understand that what he did is, well, I don't know exactly which is the eurozone, the problem of the eurozone, because of course we have low inflation, for sure. If we have a high currency, we're importing deflation from all over the world. And of course we have low growth. No? So the very one target was simply lowering the currency. Once the currency is being lowered, then you are in a better position to know which is exactly the problem of the eurozone, okay? So that's where we are now. This is because, for instance, it's very simple. If you look at everyone knows about the long interest rates, how low they are, okay? But look at the core inflation in the eurozone. It's quite stable, 0.7, 0.8. So current interest rates in the eurozone have nothing to do with current core inflation, with expected inflation from the ECB or whatever, and even with expected inflation from the market itself. Please just look at the five-year swap inflation, okay? It doesn't fit at all with current. So for me, this is very important because this means at the end that the final purpose is not having low interest rates. No. The final purpose is only having lower interest rates than the US, for instance, because it's a currency effect. And taking this into account, for instance, you mentioned CRH, a really good company. I just put another example, Ryanair. Ryanair, 1 week or 2 weeks ago, issued a bond, 8 years bond. I think it was 850 million euros. You know which was the cost? 1.12%. Do you think that Ryanair return on capital employed or return on assets is not much higher than 1%? Of course it is. So companies, for instance, the debt, I think that companies are very smart if they issue bonds, long-term bonds, as much as they can, even if they don't need the money, just to employ it. And imagine, to me, the thing of the companies in the Eurozone is quite simple. Just imagine something. Sales are in maximums. Labor costs in minimums, and many of them, because margins are increasing, corporate margins are increasing, many of them, you can argue that in a couple of years or so, labor is going to knock at the door. I'd say, hey, okay, I want a part of this margin for me, okay? You can be that. But even in this case, a lot of schemes have been changed from fixed to variable schemes, so it's not going to be the same. Then you have low raw materials, low oil price. So imagine. Then you have, automatization. It's a huge event. Look at companies like KUKA. Look at their sales or what companies are telling you. And then you have a low euro, which is it's able for you to export. So what I understand is that companies, especially in the Eurozone, have today something like an ideal world that it may last 2 or 3 years, no more than that, because at the end salaries are going to grow, raw materials are going to grow, interest rates are going to grow, but not today, no? And then I fully understand why, for instance, you see at the flow of funds this year, no? Shifting from, getting out from US equities and entering into European equities. Why not? Imagine, European equities have lower multiples. You have this issue of the cycle as well, of course. Lower multiples, but then higher earnings EPS this year, 05. So lower multiples in PE, price to book, higher dividend, whatever. But then this. And then you have the Eurozone, which is in expansion, the economy, because it's growing the GDP, and it's growing more than was growing last year, no? So it's something that I fully understand, this flow of funds shifting from one to another, no? And then, to me, the thing is that, of course, look, as I see, I think that the US investors are leading us in one sense. A couple of years ago, it appeared to us that the US stock exchange was cheap. Now, it's not cheap anymore, but it's fully valued. For us, it's not expensive. But then, the way I see it is that the US equity market was the first one, just that valuations meet prices, prices meet valuations. But I think that the rest of the equities in the world are doing the same process. So I think that the equity market, the European equity market, as other equity markets, just simply the prices are going to still growing, and this is not a case, this is not an event, this is not something that we have to worry about. Why? Because it's still cheap. But then something will happen when, imagine all these markets, you have all of them fully valued. And you have, for instance, at that moment of time, still low valuations, I mean, low interest rates. Then it might be another story, But for us, now it's prices are going up, they simply have to,
I want to connect with this. Let's get out of the macro picture for a while and also from a stock perspective. And I want to look at things from the perspective of a Spanish investor that has a relatively low allocation to European equities right now. Looking at the picture you've shown, if you want to start building up a position in European equities at these levels and at this particular point, and taking into account your different views, if you have not entered the market and you're considering right now, which type of approach do you think could make more sense? Because for somebody that is worried about valuations, might consider, well, maybe a long-short type of strategy could make more sense at this point. And if you're, Jaume, at some point believing that prices have to go up for sure, maybe you could think, well, a passive strategy might do the trick for me if I go through an ETF. So I would like to argue the case for long-only type of strategies, and especially for the value stock picking in this type of environment, and why do you think investors should try to look for active managers right now? Rodney, I would like to start with you.
Okay, thanks. Yeah, I mean, that I guess is the most important thing for the audience here, is what to do in this environment. Now, clearly equities have had a strong run. There should be a bit more to go for, but not as cheap as it used to be. So how do you, what's the strategy you employ to deal with this situation? It's an interesting question. I think from a personal perspective, and speaking to fund-to-fund buyers that we meet with, what I've found most interesting is the approach that a lot of them use, which is to try and find fund managers, active fund managers, genuine active fund managers who take meaningful positions with good active share. Genuine active managers who don't have the same style, different investment processes. So, in a world where no one really knows quite what's going to happen in the future, it makes sense to, I think, identify proven fund managers with skill and ability to outperform. But to marry that with, I suppose, a selection of managers that can do that over the cycle, but won't correlate with each other. So I think that for me would be the most sensible approach, to try and find a handful of managers, 1, 2, 3, that give you that equity exposure, that market exposure. But as I say, in a world where we're not quite certain, we look at the macro factors and we form a view. But I think the prudent approach would be to try and find managers that won't perform in the same way, and that should mean that through the cycle you get the exposure, but in a more balanced way.
Right, Rodney. It's true that you mentioned active share. It's true for Aberdeen. It's a crucial thing, and also risk management for you. Scott, in your case, one surprising thing for me is you've managed to have a very high active share with, if I'm not mistaken, with a very low track record, less than 2%, if I'm not mistaken, in the portfolio, and with a concentrated portfolio, which is quite impressive and outperforming the market. With this background, why do you think investors should look at the type of strategies that you are bringing to the market?
What we try to do is to be as pragmatic as we possibly can at all times. I think we try and recognise that at different points in the cycle, a different style works better. So there are times when a high quality sort of style which favours the sort of bond-like equities that we've seen do so well over the last 3, 4, 5 years. That has worked incredibly well. Right now, the way we're shaping the portfolio is to reflect this more value bias in the portfolio. We think that the yield issue is still very, very important. When you've got a starting yield of in excess of 3 in Europe, which is very, very unusual for any asset class, that's going to remain a strong support. And if we can find dividend growth on top of that, that's going to remain a key driver. So dividends, dividend growth, value, those are the sort of themes that we're pursuing in the portfolio at the moment. I think you definitely need more of a value tilt at the moment. We're working very hard on shaping the portfolio that way right now to reflect these opportunities. So we kind of sit somewhere in the middle, I guess, of this debate. Rather than saying we should go for value funds or growth funds, we would hope to find the right way forward for our investors, and that's definitely the way we're moving at the moment. Much more value. But keeping an eye on this income story as well. I think the impact of virtually zero risk-free rates for the foreseeable future will remain pretty profound. And if you can start with a dividend yield of in excess of 3, you are going to get dividend growth. You've got these very strong balance sheets in Europe. You've got, we haven't talked about earnings growth yet. Perhaps we should touch on that in a moment. But we think we've got a better chance of seeing earnings growth in Europe this year than in the last 4 or 5 years, put together. It's much better, the outlook for earnings growth. So you should get growth in dividends. You've got strong balance sheets. You've got shareholder returns, and at the same time, there's value there as well. So that's the way we're trying to position.
Jaume, in your case, how are you positioning the portfolio right now, and how you want to capture this potential you mentioned earlier?
Okay, good. Thank you. Well, first of all, I firmly believe in active investment, low rotation active investment, okay, fundamentally driven. And the thing is that the following, for instance, you mentioned before the oil sector or commodities, okay, we don't have any single stock there. So anyone, not now and 3 years ago or 5 years ago, no, it's not a single stock if you don't believe in this sector, no? Then the rest is about concentrated stocks, so the stocks is about 40 to 50 stocks, no more than that. And then the thing is that the way we see it is, look, for the moment, as I said before, we see these huge fundamental discounts in the market. We run the portfolio in a way that we try to maximize the fundamental discount, okay? So it's a view like a significant part of the future return of the portfolio might come from this fundamental discount that we have today in the portfolio. And then, of course, last year it was very good for this kind of bond-like stocks, really good. Interest rates were down, but we firmly don't believe that long interest rates, even in Europe, are going to be down for a long time. So we are favoring more cyclical stocks at this present of time. The Eurozone is growing, it's still low, but it's growing, improving. And then cyclical stocks, and then between value and growth, this is growth, we're favoring growth. And then between small and big, it's amazing because we are still favoring small. Why? Big has a great opportunity out there, but when the cycle goes on, and when the cycle improves and gets better, small stocks are doing better than large stocks. And for us, the important thing is quality stocks, no matter the size. No? So that's a bit how we have the portfolio today. Thank you.
Scott, yes.
So I was just going to pick up on and go back to the question, which was what do investors do with limited, no exposure to equities? How do you
build up?
Yeah, exactly, and I think that's also an important question as well, because I think this year, we've seen last year that there was volatility came back into the market. We've had, I think, it seems surprising to say at this point, but actually there's been limited volatility over the past 3 years, although with the Eurozone crisis, it didn't feel like that at the time, go back a bit longer. But we've gone through a period of relative stability. I think volatility is coming back into the market. We've seen that in equity prices, we've seen that in commodity prices, we've seen that in the oil price, we've seen that in currency in Switzerland and other areas as well in emerging markets. We're likely to see interest rate volatility over the next 1 to 2 years, clearly. You've got geopolitical risk as well, which is more heightened than it has been historically. You've got China negotiating a soft landing. You've got Brazil potentially going into recession, and you've got issues in Russia. So I think the outlook is one that is more volatile than it has been, and I think it would be sensible to maybe be mindful of that and to maybe look for volatility as opportunities to gradually build up that exposure rather than necessarily using today as the buying opportunity, and try to be a little bit tactical as well.
I completely agree with that. I think any entry into any asset class or any stock over time, you need to take your time, you need to average, you need to make a start now maybe, but be ready to add.
Perfect. Scott, you mentioned earnings and the discussion about the earnings growth potential. I think something we should go into. Also, Jaume talked about small cap potential. One of your themes is also mid cap growth, I believe, in the portfolio. But I made a promise at the beginning. I said that this should be an open discussion, and if you at any point want to ask a question, please just feel free to jump in whenever you want. Just a warning, I come from Venezuela. If you see our president or soap operas, it's endless talk, so please interrupt me at some point. Let's come back to the earnings part. Would you like to share with us your view about the potential of earnings growth for companies in Europe and in your portfolio in particular, what are you expecting?
Sure. Well, the big problem in Europe has been earnings growth. The reason why this gap has opened up, the gap between peak earnings and where we are now has opened up, is because the earnings haven't been delivered in Europe and they have in the US. So this is pretty crucial, really. So we're looking for evidence that this low euro policy is working. It's very difficult to look at the aggregate numbers for the reasons that we discussed. The sectors are very different. And we've got this huge sort of burden of lower expectations from oil and commodities that are impacting the overall earnings growth numbers for the market. But if you look at the earnings revisions outside of energy, for example, we're seeing positive earnings revisions now. If you strip out the energy and commodity stocks, if you look at the exporters, if you take a very, very broad basket of export-based stocks, then we're seeing 80% of those stocks enjoying earnings upgrades at the moment. So there are signs that that the currency effect is beginning to help, and there are signs that with that, with leaving perhaps energy and resources to one side, which is really going to hurt a market like the UK market, where earnings will go down this year. Outside of that, there is some quite strong earnings growth. So the aggregate number of around about 8 to 10, which I think is consensus now, to us looks achievable. I think we've seen the bulk of the hit, if you like, from energy and commodities. Obviously, it could get worse, but those earnings bases are now much smaller. So as they get hurt further from here, then the damage overall is less intense. So 8 to 10% this year. Again, with careful stock picking, I think you can build a portfolio with an earnings growth prospect in excess of that, with a starting yield and starting valuation that's slightly lower than the market. Sorry, high yield, lower PE. So you can build a sort of value tilt into the portfolio, which is what we're trying to do to capture above market earnings growth at this stage. That would be our approach.
Perfect. Rodney?
So I mean, in terms of the prospects for earnings growth, I think clearly it's favourable. Certainly helped by recent central bank activity in the eurozone, and there are a number of tailwinds: currency, low interest rates, increase in consumption, low oil price. The US consumer is picking up, and we could even see wage growth in the US coming through before too long. So yes, I think the general backdrop for earnings growth is encouraging. The general backdrop for I think the European macroeconomy is generally encouraging. There's still a lot of heavy lifting to do in terms of reform internally within Europe, and I'm sure we'll maybe come on to discuss that. But I think yes, the backdrop is favourable. The question for us, though, comes back to how much of that is already in the share prices. And that is why it's so difficult, because a fair amount, we would argue, is already in the share price. But that's not to say that, again, if you're selective, there will be opportunities. But I think you will need to be selective.
Jaume, before I go with you, one thing we've been talking about the oil price all the time. I would like also to connect with that. You've been commenting on both aspects of it, both the opportunity for some companies and the challenge for others. You've mentioned the weight in the UK of the energy sector. It's true, Jaume, if you look at the evolution of the oil price from the Spanish perspective, the net effect is fantastic. I mean, it's a very good it's a very good news for the Spanish market in particular. If you don't mind, tell us a little bit your view on the earnings in general and for the portfolio, and also the effect that you expect from the oil price.
Well, the oil effect is very good. It's very important. First of all, when oil goes down, the GDP world grows. Okay, so it's a positive effect. It was the economists that said, I think, 10% when the oil price is going down 20%, no, more or less, 50% going down the oil price is plus 1% in the GDP, in the world GDP, okay? But then this is very different because it is not favoring everywhere. For instance, one of the, I have here, imagine, in the Eurozone, the production of oil is about not less than 4 million barrels a day. And the consumption is 14 million barrels a day. So we're importing 10 million barrels a day every day. So it's very positive, you know. For instance, you mentioned Spain. In Spain, there is a difference. For instance, more or less the net importing from oil in Spain is more or less 4% of GDP. But if you go to France or to Germany, it's about half, 2% of GDP. So in Spain, it should be a special positive effect, okay? But then if you look at that, what does it mean that many companies, imagine Norbert Dentessangle, okay, the French company, #1 in Europe in lorries. They have 5,000 or 6,000 lorries driving every day. How much does it mean when they pay the bill? No? And then to me, the most important thing is, because you can talk about the oil as in many other commodities, but it's a bit different. For instance, this is not like iron ore, you know? You look at the iron ore case, you look Australia being the first exporter in the world, and you look that when iron ore was at 190 and 170 and 60, they just produced a lot. So it's a matter of over capacity, you know, they just produce a lot. If you look at the exports in 2 or 3 years, plus 45%, just because the price was up and they just put everything under production, okay? If you look at the oil, something is similar. If you look at the oil, the Total did 1 or 2 months ago, they just said, oh, we have been wrong. We have built too much drillings and, you know, these kind of things, saying the investment has been, the capex has been too excessive. We have to reduce capex and cost. But then in the oil, there is something more significant, which is the shale oil, because this makes a huge difference. I fully recommend you one book, which is called The Frackers, okay, that I think that in the business schools, it's going to be compulsory, you know, in the next years. Why? Suddenly, when you have the oil price at 120 and 140, well, the big oils, all the big oil companies, they didn't see the fracking or the shale, you know. They just, okay, if you have one, you know, oil field in the US and it's finishing, they just went to Nigeria, okay, and they built another one. But all these really entrepreneurs, US entrepreneurs that had one oil field that was going to be finished in, let's say, 15 years, these guys were investing a lot, just trying to find out a different kind of oil, which was the shale oil. They invested a lot, and it's very funny because if you look at this book, for instance, you see how they explain it. All the big companies saying, what are you doing, drilling the rock? You're crazy. Huh? And then engineers they had in the company, imagine, you're working in a company, you have oil for, let's say, 10, 15 years, and they put you not in this side, but drilling a rock where you have no oil, and for years. Huh? So many of these engineers simply left the company. And it's funny because one of these guys, which was George Mitchell, simply says, and even when I arrived home, my son or my daughter, whatever, told me, but Dad, what are you doing? The future is just is sun, you know, wind, energy, whatever, no? And this guy was there until he discovered a lot. So for me, is amazing. So the huge difference in the oil field is that nobody and when I mean nobody is not, for sure, not the big companies, but not the countries, not the exporter oil countries. None of this thought that these guys could extract every year. I think that today, more or less, in the US, shale oil is about 5 million barrels a day. So, which is the good thing about that? The thing is that the oil price, I mean, why everybody today is producing more oil? Nobody is stopping, even if the oil price is going down. Nobody. You know, but the OPEC countries or whatever, they are producing as well. Why? Because at the end, the true message is just the oil price has to be lower than the marginal cost of producing shale oil, which, be careful with that, because this marginal cost is going to getting lower. With the next years, it will be lower than today. And which is this cost? In principle, nobody knows, because every single field knows. But they have to report to the US authorities, and the US authorities said something which is not new. They simply said, with the barrel at $80, the price of the oil at $80 per barrel, 98% of the facilities are profitable. And with the oil price at 60, 83% are profitable. So what does it mean? That if the final purpose of the oil is just killing shale oil, the oil price has to be lower for a while. And be careful, because if it goes up again, all these guys will go on. And then in December, all the new licenses for shale oil in the US were finally stopped. But imagine the perspective. You have shale oil not in the US. In most of the countries there is shale oil. So this is why I think that oil is going to be cheap for a while. You know?
Thank you very much, Jaume. I have a few more questions. I don't know if you would like to introduce a question from the audience. If not, I have a very brief one, because we're also conscious of the time. I would like to ask you very briefly, to each one of you, if you could share with us 2 or 3 of your best ideas right now in the portfolio, 2 or 3 themes that you think could play out well in the near future. Scott.
Okay, well, perhaps I'll go for a quite a high-risk one first, and then perhaps something a bit safer afterwards. I think, you know, one of the deep value areas of Europe at the moment is the steel sector. And you know, to all the points we've been making, lower energy costs, you know, much lower euro, and the EU now talking about imposing tariffs, anti-dumping tariffs on stainless to start off with, and maybe other forms of steel as we go forward. You know, these stocks are, you know, have been incredibly poor investments for a very, very long time. But there's just the sort of deep value European industry that may benefit from this, you know, all the factors we've talked about. So I would look at a stock like Salzgitter, which is a German-based mid-cap size company. It has, you know, one of the things that's very important to us in all our investments is the balance sheet, and it has a good balance sheet. Big pension deficit, but 400 million euros of net cash on the balance sheet.
What's the name of the company, sorry?
Salzgitter. And you know, it trades on 0.2 times sales. It doesn't produce stainless steel, but it produces all the other varieties, and it trades it as well. So it's a very cheap stock. A lot of restructuring going on. Restructuring is a big theme for us. I think if you're creating a value tilt in the portfolio, you've got to look for restructuring stories. Huge restructuring going on here. So that would be at the sort of really deep value end. To choose something perhaps a little bit more, a little bit safer, that perhaps reflects this sort of income yield search still, which we still think will remain important. I met with Ahold, the Dutch food retailer, the other day, and 2/3 of that business is in the US, because it has a big US food retail market share. So huge benefit from the dollar on translation. A little bit better inflation characteristics in the US as well, which makes it easier for a food retailer. And they're trying to do in the US what Kroger have done. So they're trying to go a little bit more everyday low price. Kroger has been a huge success story. You look at the share price of Kroger, it's phenomenal. Ahold also has some great balance sheet characteristics, you know, which again, as I say, we always focus on. Has some medium to long-term debt that's quite expensive that will work off over the next 3 or 4 years. So you've got a really nice story in terms of funding costs coming down. You've got great cash generation. They generate €1 billion of cash per annum. which they typically return to shareholders in dividends and share buybacks. Valuation, it's about a 3.5% yield, dividend yield, but with nice dividend growth. And it's got this buyback support as well, P multiple of about 16, 17 times. So, and usually it is a sort of averagely rated sort of stock. So we see, we see value in those sorts of areas.
Very good. Very good. Rodney?
Yeah, I mean, again, a difficult question, because I think you all heard my message really, is that it's not an easy time for standout value, I have to say. At Aberdeen, I mean, just to give you a sense of our investment approach, is that we're very much bottom-up, long-term buy and hold investors. Mm-hmm. Don't churn the portfolio. Turnover is very low. We're looking to invest in high-quality businesses, what we call high-quality businesses, which are, again, as I touched on, businesses with access to long-term structural growth opportunities, international diversification, robust business models, strong competitive positions, high barriers to entry, good customer relationships, intellectual property, and combined with strong management teams and strong balance sheets. So those are sort of the types of businesses that we're looking for. And you're having to work a little bit harder on valuation to justify where we're at. Now, we don't take the approach where we try and be tactical or try and change our approach depending on the market environment. That's not what we do. So again, I think the best ideas that we've had for the past 2 or 3 years are still, I feel, the best ideas. So then you look at those ones that have perhaps been a little bit weaker in terms of the share price performance, those that perhaps actually haven't performed exceptionally well, but have sort of held their own. And so there is, you can still say that there is value for the long-term investor who's willing to be patient. And a few names come to mind, but I think Schindler, which is the elevator business, is a fantastic business. The rating has always been high, and it's always been a significant premium to the market. The premium is less so now. For those that don't know, Schindler is in the business of elevators and lifts, and there is structural growth, urbanization, emerging markets. There's a renovation cycle in Europe. There's 4 players in the industry, so it's concentrated, it's rational. It all makes for good returns over the long term, and half of its profits comes from the servicing of their equipment. So a very robust, resilient, stable income stream. So you've got a number of attractive attributes there, and the business is trading on a 4.5% free cash flow yield, which actually I think it is pretty attractive for a business that is as strong as this. And certainly if you go back to bonds and credits, that yes, you make the case that 200 basis points on investment grade bonds versus a 4.5% free cash flow, you actually that is good value. So you don't have to take a huge amount of risk in terms of the business model and the prospects, but you can participate in that valuation arbitrage opportunity. So that's one thing that's interesting. Rolls-Royce is a business that you may be familiar with, not the car maker. Rolls-Royce is the aero engine turbine manufacturer, the marine business. It has a huge amount of operations and businesses to the offshore oil and gas sector. It has a defence business. So those two in particular are areas that have been actually suffering from near-term operational challenges, and that presents an interesting opportunity to investors. It's trading on a sort of a market average PE of 15 times. It's a business on the civil aerospace side where it has the engines, and the real value is in the aftermarket and the regular servicing and spare parts of the engines, which have 25 to 30 year lives. Captive aftermarket that no one else can compete away, very profitable, and strong growth in air travel, again from emerging markets, and general growth in GDP. So those are two businesses. I mean, I could go on, but there is value. You do have to look a little bit harder, and you do maybe have to look at those that have some short-term pressures, that are genuinely short-term pressures rather than the long-term, and perhaps squint a little bit on the valuations.
Yeah, one of the sectors that we are favoring the most is asset managers, because with this view you may imagine that assets under management are growing, and then there is a bright future in the long term and in the short term. And I shouldn't say that, but one of the shares that we have in our portfolio is Aberdeen. Okay, so asset managers for sure, and then we also, for instance, there are Saint-Gobain, companies like Saint-Gobain, very in favor with the lower euro is affecting them very positively. It's a very good one, a very good company. Other companies like, for instance, Boskalis, for us is one of the top stocks in Europe. And then, for instance, many other Munich Re, there are some of these companies that we have in our portfolios for ages. No? And they have run a lot, but we think they are much lower than our valuation. Okay.
Very good. Is there any question? Yeah.
Thank you for sharing your thoughts with us today. My question is about share buybacks. I want to know what are your thoughts about this, because we've seen that it's been a big thing in the US, and I think it's starting already in Europe. I think last week Siemens announced a huge share buyback, and it seems to me that it's a very tricky way to create value for shareholders. And I guess that if they would see the color of the wall as pink as you share with that, you said to us today, they would be doing something with that with money instead of buying back their own shares. Thank you.
Okay, well, just one question, because this is important. This point for me is extremely important, okay? Because now, imagine you are the CEO of one company, okay? You see your company that, for instance, the value is 10 and is trading at 8, no? Just to say an example. One of the easiest ways to create value to your shareholders is just to buy back your own shares, okay? You create them, you just then eliminate the shares, of course, and then you are creating real value for your shareholders. But the thing is, because then it's simple, more or less taking into account the US and Europe together, but the effect is much higher in the US than in Europe, more or less, almost the same amount that has been paid in dividends has been used in buybacks. So imagine something like that. You are the CEO of the company, and you say, okay, my net profit is 100, I pay 40 in dividends, and 40 or 35, okay, what I do is I simply buy back my shares. And you really create value. This is why this is very important, because, well, this is one theory, but my theory says the sooner the fundamental discounts disappear, okay, so the stock exchange is going up, this effect is going to be worse for the CEOs. It's not going to be so simple for them, no, like buying back shares. Then, if your share is not cheap, then you will have to do something else. For instance, create a new factory, okay? Just to add value to your shareholders. This is why it's not only that the economy leads and then the stock exchange goes behind. No. If the stock exchange just simply goes higher, it probably could mean a positive effect to the economy as well, okay?
Yeah, over there.
I have a question. It's regarding the performance of the indexes in Europe. We've seen the IBEX do something like 6% this year, and we've seen the rest of Europe, let's say, more than double, 14%. Even Portugal has done 14%. And then again, Spain is one of the economies that is growing the most in Europe. So my question is it really the political issue, like there's some sectors of the market are saying that is the Podemos effect? Or is it the index composition, or is it something else? It's what's wrong with the IBEX this year?
Great. And if you don't mind, I would like to also link this and ask you a general comment on political risk in Europe. And not only Spain, but also if you don't mind to comment in general. You mentioned geopolitical risk during your commentaries, Rodney, but let's stick it to Europe. What's your view on it? I don't know who would like to start.
I don't mind.
Okay.
Starting with a few comments. I think there has been a little bit of an index effect. We've had a very large and not entirely expected rights issue from Santander this year. So, that's one example. Telefonica, I don't think it's been one of the better telecoms places to be positioned. So the IBEX has some very heavy constituents that do have that effect a little bit. But I think you're right in terms of highlighting the politics as well, because if you look at stocks that are more comparable across Europe, so I'm thinking of the Spanish banks, outside of Santander, the domestic banks, the media companies, for example. I mean, we own Mediaset España, which we think is an incredibly high quality situation, but it's been quite stagnant as a share price this year so far, whereas other media stocks in Europe have done very well.
Also Bancaire, right? Bancaire as well?
Yes, Bancaire as well. We own, again, very high quality domestic domestic play. And you know, you compare those stocks to other similar stocks in Italy or elsewhere, and they have lagged. So I think there's definitely been a political effect. I think, you know, to move on to that, you know, we were talking about this last night when we met, and you know, the situation in Greece is not just important for Greece and what it means for them. It's important as a sort of indicator of where the rest of Europe goes. And I think people are rightly or wrongly making this very strong connection between Podemos here and what's happening in Greece. And if Greece is seen to be, you know, if the Greek left wing is seen to have won a big victory, stays in Europe with lots of lovely concessions, then the fear, I guess, is that will encourage support for the left wing here in Spain. So I think that's an important factor to watch, and it's obviously going to continue to play out for a few more months. But in terms of value, I think we see some very good value in some of those stocks that we've mentioned in Spain.
Right. Rodney?
Yeah, I mean, to go back to the question, I think I made the point that I think it's an index factor, really. It is the big swing factor. But part of that is political risk. Podemos is a risk. The risk that we saw in Greece, whereby a government comes in and tries to roll back on some reform, would be a negative to the economy. Any discussions, negotiations with Europe is a problem for sentiment, for confidence. So the macros are still finely balanced, and there is an element of political risk that one needs to think about. And I suppose the banks are hugely geared plays on the domestic economy. So that's a big part of it as well. But I mean, I think the political risk is a difficult one for I guess, finance guys like ourselves. We're not used to necessarily focusing a huge amount of effort on the political situation. But yes, I mean, there is a tail risk, and there's some important elections happening in Europe this year. Not least Spain, UK. Again, there's likely to be, if the Conservatives, with the incumbents win the election, there's likely to be a referendum on EU membership. Again, that's more uncertainty, and that's going to damage, I suspect, the UK economy. And again, there's a sort of sense that we've sort of moved away from the whole is the Eurozone going to break up discussion, debates globally, you know, is off the table. But there is a risk that it comes back, and there is a huge amount of reform, of structural consolidation, of pain being felt by huge swathes. I mean, I don't need to tell you guys here in Spain. I'm sure you're all too familiar. Spain's something of a success story in what it's achieved so far. But in France, in Italy, these are countries with very modest growth rates at best, and implementing a huge amount of austerity still. And you know, how much is the electorate willing to take the Troika's medicine? Because it's an incredibly difficult period for a lot of people, and you tend to see that reflected in the polling station. So I think there is a risk that there is a backlash against this period of austerity, and I think actually Germany and the Eurozone is aware that it's pushed as far as it probably can go. So I think, as with the Eurozone in general, it seems to be that Europe does what it has to do late, at the point where it has to do it, it's forced to do it almost. And there's a degree of logic to that, because I think in terms of Germany getting that through their electorate and politicians with their domestic politics, and also, I suppose, needing a stick to encourage the likes of the Italian and the French government. They do need to push on structural reform if the Eurozone is going to remain a viable project for the long term, because there are huge imbalances in the economies, and those need to be addressed. So I'm reasonably relaxed, but I don't think we should be complacent on the political side.
Jaume?
Yeah, well, I would say that, imagine if you look at the Greece situation, for instance, what we saw last year is the following. The stock exchange in Greece was down almost 29%, and the Eurozone was up, the Eurostoxx 1% or 3%, depending on the index. So the thing is that, for me, the most important thing is that we are in a situation where the economy is improving so much that even political risks, in this case, have more chance to be local than global, okay? So imagine the great difference in Greece is that it's affecting Greece, but it's not affecting the Eurozone. And imagine just this year, it's no matter. Remember that on the 29th of December was said that there were to be elections in Greece, no? So relating to Spain, I think different factors, okay? One might be the political risk which is there. It might affect a bit extent, of course. it's not, I mean, be careful because the elections are in December, okay? So there is still plenty of time. It's some kind of effect. Santander was an important one. The weakness of the domestic banks is very particular to Spain. I mean, it's a bit different, the situation of domestic banks in Spain related to other countries. And then just one question. I mean, all this money which is coming into Europe, you know, flow of funds positive into the European equities, just put, imagine you are the guy in, I don't know, in Singapore that you are managing a fund, okay? And then you say, okay, I want to buy European equities. Well, it's more likely that you start with German equities than with certain Spanish equities, for instance. So this effect, no? And then many of the effects, for instance, look at, it depends on which companies do you have in your index, okay? Just to put an example. If you have Airbus, which is competing with Boeing, and Boeing, now the currency effect is favoring Airbus and not Boeing, probably Airbus is doing much better than Boeing this year. And if you look, for instance, in the tire industry, Goodyear, the American one, is down 10%, but Michelin, the French one, is up 12%. And Bridgestone, the Japanese one, which still has the currency in favor, is up 14 or 15%. So it's different factors, okay? But at the end of the day, for us, the fundamental value of the IBEX 35, one by one, so single stocks, is 13,000. So we are at 11,000, so we have still room to go, okay? But for me, it's not rare if Germany goes first and then we go the rest. For me, it's not rare at all, you know?
You can see that in the funds flow data, actually. The ETF fund flows into the DAX and CAC have been very strong, but nothing really elsewhere.
For the periphery, yeah. Yes? No? I don't know if, is there any more questions? Are there any more questions? No? I have one more. I know that we are a little bit on time already, but I would like to ask you your view about the euro. What's your expectation for the euro for the rest of the year? If you can take out your crystal ball and.
Gosh. Save the hardest question to the last. I think, as Rodney said, when we get into the realms of politics and geopolitics and things, as a fund manager, your edge has completely vanished. And we don't profess to be particularly strong on currency as well, but I think it's been not easy. It's never easy, but it's been very understandable. The ECB made a big point about the euro, and then the euro got into this downtrend, and so it's been fairly clear what's been going on so far. I honestly don't know how much further it goes. I think I think the ECB will continue to see it as a very key indicator. We'll try and keep pressure on the euro. Whether we go to parity against the dollar, I think that would be. I personally think that you'd start to see the US economy. People would doubt whether the US economy can keep up their sort of growth rate with such a strong dollar at that stage. So you may get, maybe this is 6 months down the road, but maybe you get a bit of a thought that, well, if we've seen the first rate rise in the US, maybe with an even stronger dollar, that might start to weigh back the other way a little bit. So if I had to guess, and it is a bit of a guess, I would say there's probably not too much more weakness left.
I'm not going to guess. I have no idea. I can see that it is likely to remain depressed versus the dollar. That is clear for obvious reasons. I have no idea where it's going to end up. And we don't try to predict currencies. What we do is we try to invest in businesses that aren't a slave to currency, that don't rely on currency differences or strong or weak currencies in order to be competitive, to have strong positions. We try and avoid that. We look for businesses with pricing power who are able to offset FX if it goes against them, hedge sensibly to give them time to do that. And we are seeing some businesses that are benefiting from this FX tailwind. And clearly, if you have dollar revenues and you have euro costs, that is a good thing. So we can see that in some of our investments. So we participate in that, but we don't want to get too carried away because currencies can over time, and as investors in equities, you are long-term investors, they tend to mean revert, and for a period of time that is there, but I don't think we should get too carried away. Yes, it's a helpful tailwind, certainly from a macro perspective, and for certain companies at this point in time, but we prefer to rely more on the fundamental strengths of the business themselves rather than the currency.
Great.
Well, just to say, if you look at the behavior of currencies, at the end they always go to the fundamental value of the currency, but the difference between currencies and other, for instance, equities or whatever, is that the periods of the currency being expensive or the periods of the currency being cheap are very long, are longer, So what happens? We have had almost since Lehman Brothers, expensive euro or cheap dollar against the dollar, and now if you look at this behavior of the currencies, we should have a lower euro for a while, So even I said before, for us the right price is about 117, and we are at 108. It's more likely that we are a few years with a low euro than a few years with a hard euro again, It shouldn't make sense,
Perfect. Great. Well, I think we're done, right? Would like to thank, first of all, I would like to thank the panel. It's been a magnificent panel. Thank you very much, the three of you, for your participation. I would like to thank also GVC Gaesco for inviting us here, and thank you very much to you for attending and for your questions as well. Many thanks. Bye.
Una última cosa, perdón. Soy Felipe Lería, responsable del mercado institucional de VP para España, y estoy aquí pues con Ana Guzmán, que es la responsable, perdón, no se me ve aquí, para Aberdeen, y Mónica Arnau, que es la responsable para GVC Gaesco. Sí que queríamos dar las gracias, evidentemente, a todos los ponentes, sobre todo a David Anglés por haber accedido a moderar este debate, y sobre todo a todos ustedes pues por haber asistido también. Espero que haya resultado de su interés, y a la salida, sí que no se vayan, hay un detalle para ustedes, a la salida que les dará una persona que hay ahí. Gracias.